This is NBZ Report. I'm your researcher bringing you the deep dive analysis no one else is giving you. So today, we're looking at a project backed by SiriusPoint, literally a publicly listed New York Stock Exchange traded insurance company, along with Coinbase Ventures. Yet somehow, despite having that level of heavy-hitting institutional backing, ReProtocol is flying almost completely under the radar. But you know what? By the end of this three-part series, you're going to understand exactly why this project matters so much.
Okay, that is a huge claim to make right out of the gate, especially when you see their CEO, Karan Saloya, out there calling this a decentralized Lloyd's of London. I mean, Lloyd's is an absolute titan of traditional finance. Are they really building something on that massive of a scale? They actually are. And honestly, the mechanics behind how they're pulling it off are just fascinating. Because there is so much to unpack here regarding their structure. We're making this part one of a three-part deep dive series.
In this explainer, we're going to cover 4 critical areas from our research report in full detail. We'll kick things off with a project overview to grasp their actual scale. Then, we'll look at the specific team and founders behind Re. After that, we'll break down their technology and capital stack, and we'll wrap up by diving into the use cases and real-world applications. Let's get right into it.
All right, part 1, project overview, operating at institutional scale.
So, the very first thing you need to know about ReProtocol is that this isn't just some white paper project. You know how most real-world asset projects launch a token way before they even have a working product? Not Re. Their underlying protocol has actually been operating for years prior to their token generation event, and they are playing in a massive arena. The global reinsurance market is roughly a $700 billion industry. Historically, it's been this incredibly opaque, closed-door market concentrated among just a handful of major carriers. What ReProtocol is doing is taking stablecoin capital and channeling it directly into this space. They're opening up fully collateralized reinsurance contracts to a much broader base of capital providers. Okay, wait. If they've been operating for years before their token even launched, what does their actual footprint look like right now? Like, is there real capital flowing through the system?
Oh, absolutely. If we look at their total value locked, their TVL, as of June 2026, they are sitting at a staggering $465.69 million. And the breakdown of that number is what's really wild here. That consists of $80.37 million in on-chain capital, $177.45 million in off-chain capital, and a massive $207.87 million in actual premium receivables.
To put that kind of scale into perspective for a second, ReProtocol has already reinsured more than 1 million U.S. policyholders. They've processed over $500 million in underwritten insurance premiums, and they are actively working with over 40 different insurance and reinsurance partners. So yeah, this isn't theoretical at all. This is real-world adoption happening at scale.
Moving right along to part 2, team and founders, and what we call the cover connection.
You know, that scale is pretty staggering for a crypto project. But it begs the question, how does a team with a crypto background manage to secure over 40 massive real-world insurance relationships? That industry is notoriously walled off and difficult to break into.
Right, and the answer to that lies directly with the founders themselves. Look at the core team here. You've got Karan Saloya as CEO, Cliff White as VP of Engineering, and co-founders Anand Dhillon and Ben Anish. This isn't just a group of crypto natives who suddenly decided, hey, let's spin up an insurance narrative. This exact same team previously built a company called Cover. Cover was a venture-backed insurtech platform that operated as a fully licensed brokerage. They distributed auto insurance through 5,000 independent agencies and managed to raise $27 million from major TradFi players like Exor, Tribe Capital, and Sandhill Angels.
Now, Cover was actually underwriting profitably, but when they ultimately wound the company down in 2022, after some funding and acquisition efforts fell through, the team didn't just pack up and walk away. They successfully transitioned their real-world reinsurance relationships directly over into ReProtocol. Because of that, relaunched with real insurance premium flow from literally day one, initially seeded right from Cover's own auto insurance book. They basically brought a decade of direct, hands-on exposure to insurance regulation straight into DeFi.
Which brings us to part 3, technology and capital stack. Let's look at the institutional mechanics. So they literally built a licensed insurance company first and then entered crypto second. That completely flips the usual script. Let's dig into those mechanics though. If I'm a depositor putting my stablecoins into a complex reinsurance framework, my first question is, how is my capital actually protected if a bunch of insurance claims suddenly hit?
Spot on.
To handle that, Rio uses what they call a 3-layer loss hierarchy. It's designed specifically to protect depositor capital. So, step 1 is the reinsurer's equity. If there are losses, the reinsurance company's own equity absorbs them first before any depositor capital is even touched.
Then we move to step 2, the junior tranche. This is represented by the RWAs token. If losses exceed that equity layer, RWAs absorbs them next. Now, because depositors in this layer take on that added risk, they earn a much higher spread, around 850 basis points, which is 8.5%. And finally, step 3 is the senior tranche, RWAs. This sits at the very top of the stack. It's highly protected by those 2 lower layers, earning a lower 250 basis point or 2.5% spread, but it offers significantly better protection and liquidity.
But honestly, the tech stack is only half the battle here. The legal structure is their true moat. RE deliberately separates the token layer from the regulated insurance entity itself. Cover Re SPC is actually a Cayman-domiciled reinsurer, and it secures its liabilities using something called Regulation 114 trusts. This is a very specific regulatory structure that holds 100% cash and investment-grade assets in segregated trusts. Doing it this way allows the collateral to qualify as admitted by U.S. insurance regulators. It is an incredibly regulator-friendly setup, especially compared to your typical DeFi project.
Yeah, that level of strict compliance is definitely rare in the space. But what about transparency for the end user? If I'm holding these tokens, how do I actually know the value of the assets backing them on any given day? That is exactly where Chainlink comes into play. RE Protocol does daily net asset value, or NAV, recalculations automatically every day at UTC-000, powered by Chainlink oracles. Plus, they've built in these strict guardrails to prevent outsized single-day price changes. So it ensures you're getting both transparency and stability as a depositor.
All right, part 4. Use cases and real-world applications and the true value proposition of the protocol. This brings us to the core of why institutional capital actually cares about this specific structure. Right, because let's be honest, yield in crypto is usually a bit of a dirty word. It's mostly just token emissions, lending demand, or trading fees. And we all know that kind of yield completely vanishes the second a bear market hits.
Hit the nail on the head. The contrast in where this yield comes from is striking. Standard crypto yield is highly correlated to the price action of Bitcoin and Ethereum. But RE Protocol's entire thesis rests on a genuinely uncorrelated yield source. It is driven by real-world insurance premiums and actual underwriting performance. So whether Bitcoin goes up, down, or sideways, real people are still out there paying their insurance premiums, and that creates a steady, truly uncorrelated flow of capital.
Now, here's a crucial point we need to clarify regarding the actual RE token itself. The RE token does not directly earn this insurance yield. I repeat, it doesn't earn the yield. That yield flows exclusively to the RWAs and RWAsDE stablecoin depositors we were just talking about. The RE token is strictly a governance token. Its utility is all about controlling protocol upgrades, managing technical permissions, overseeing committee formation, and dictating the incentive policies for the shared infrastructure.
Wow, okay. Governance moves from the hands of a single sponsor into the hands of a community. That is a massive responsibility. You're giving a decentralized community the keys to govern a protocol that's managing nearly $500 million in real-world insurance assets. That is a very serious undertaking.
It really is, and exactly how that governance plays out in the open market is what we're going to be exploring next. That's it for part 1. If you found this valuable, make sure to like this explainer, drop a comment with your thoughts, and subscribe so you don't miss part 2. See you in the next explainer.